I did go through your Capex report. In fact, that's probably one reason why we thought it'll be lovely to do this conversation with you. Enough and more sound bites out there from companies which are feeding into this Capex or benefiting from this Capex, saying that this is the kind of demand that they haven't seen in a really long time. Yeah. But the punchier or the really high quality assets, Unmesh, as I look around different themes which benefit out of this, are almost priced to perfection, if you will, at least on the earnings basis, if not the cash flow basis. So now enlighten us on a cash flow basis. Where is it that you find favor within this whole wide bucket of Capex beneficial?
Okay, so look, this is a quandary that we are facing as well, right?
Achha, okay.
Okay, so this is not straightforward, but at the same point in time, let me try to answer this, right? So look, are we convinced this is a multi-year cycle? Answers yes. Okay, that's the starting point. Now, we've seen this happen in the same sector in 2001 to 2008. More like 2005, 6, 7, 8, where we felt like we are going through a big Capex upcycle, and everything got kind of priced for that. Now, if something's 30 times earnings, but if there is a risk to earnings upgrades, then it's not 30, it's 20 or something like that, right? Now, what's happened is that there has been a hiatus in Capex for 10 years. And that's what the data is saying. So if you read, in fact, that's the first line in our report, that after a hiatus of 10 years, we have now come back, right? If you read the Capex report, what we are saying is that if there is a 10-year cycle which is reviving, and on top of that, there is such a strong push from the government, and we believe there is a very serious, there is a lot of seriousness on this. This could be a multi-year cycle. Now, if a year or two of that is priced in, that's not ideal. And which is what my starting point was, that the market's still quite expensive, but at the same point in time, on a relative basis, that is still something that you would want. Two reasons. One is because the great thing about Capex, and this is something that a lot of newer investors have forgotten in this age of new age technology where everything is making a loss, right? Because you're all betting on what will happen and you have no clue where the revenue is going to come from. You don't know when the profits will come. Is that Capex is typically a multi-year cycle. So the moment it gets announced, you have reasonable visibility on where it'll go. You can debate what will happen to traffic. You can debate what's happening to demand. You can debate whether we'll export or not export. All of that is possible, but you know that the Capex is coming. The second very important thing is that very often, of course, this is not always true, but generally, if you are backing the right management with a good track record, whom you can trust, then you have to understand that they're putting money on the table. This is not the old days where equity infusion by corporates or by promoters into companies was very little. The banking sector has changed completely since 2015. So if you look at, in fact, this was one of the things that was told to me when I joined in 2017, HDFC Bank, Mr. Puri was still there. He said that, look, I was an equities banker, right? So they would say that, the relevance of equity markets in that sense has gone up because unlike the previous two cycles of large Capex, this time the banks are actually going to ensure that there is a lot of skin in the game from the promoters. Unlike 2015, where it was easy to kind of go bankrupt, dump the assets and walk away. If you look at the way in which the government has formed all the new, there will be slips. Okay, let's not assume it's a perfect world, but at the same point in time, to a large extent, there is a push from the government as well as from the banks to ensure there's enough equity in there. What that means is that the skin in the game for the promoter is there. So if a Capex gets announced on a management that you already like, okay, the probability that it actually will play out because they have some visibility on demand is higher. So it's a little easier in that sense to invest in long-standing projects, long duration projects in infra as compared to the new age technology sector, and which is why we don't mind paying a little bit extra if that is the only way to get into the game. I'm sorry for the long-winded answer, but what we are trying to say is the visibility is better.
No, thank you for that long-winded answer because it explains your thesis. My question only is, are you paying a little bit extra or are you paying a lot extra? On an earnings basis, it seems a lot. So that's why I'm trying to
get to the crux of your argument. Look, FY24, look, a lot of these, will start to show up in numbers. See, what happens to a typical Capex project is it first depresses your earnings for a bit, right? So there is already that pressure which comes because the financing cost comes in the, while it goes into balance sheet, but at the same point in time, some of it starts to depress the EBITDA as well on occasion, right? And then it starts to show up after that. So you have to kind of discount 18 months of earnings anyway, right? On top of that, we are coming out of a cycle which has not been great. So, cyclically also earnings are not even in a mid-cycle scenario. They may be early cycle or even, reaching mid-cycle. So there is a potential that earnings goes up. So now, I know we don't propagate investing in FY25 earnings, but that is one thing to think about as to where this is going. So from that perspective, you are a bit early, yes, but you are early into something which has a higher probability of conversion. What we would call earnings visibility is a bit better. So in that sense, and you're investing in good companies. You see what is in our model portfolio, like Larsen & Toubro, Siemens, Cummins, or Capex in a different way is Ultratech Cement, right? Or for that matter, if you look at the chemicals story, we have Aether Industries in there, we have Aarti in there, we have Navin Fluorine in there. These are all companies which are anyway rock solid, right? These are companies we like anyway. And on top of that is the acceleration that you see on the revenue line. So in every cycle, including this one, there are sectors where the market wants to pay for Capex. There will be companies even today where you would announce Capex and nothing happens to the stock because you don't have visibility on the longer term drivers for that, whether it's China plus one, whether it's import substitution, whatever it may be. But in these ones, we see that, which is why we believe that, even if it's expensive, you might as well get a foothold in the door. You start investing. The market sees some kind of correction. You keep doing that as you go and kind of build larger positions in this, well over the benchmark that they have in the Nifty.